purpose of my short video today is going to be to discuss a couple of the concepts from chapters 4 and chapter 5 in the Fro book. So the first thing I've done is I've set up a short spreadsheet to calculate things like break-even, marginal revenue, marginal cost, total revenue, things like that. So what I have done is I've set up this example. Assume that we're selling widgets. A widget sold for $5 per a unit. That the variable manufacturing costs, that would be my direct materials, my direct labor, my variable factory overhead, those are $1.50 per unit. My variable selling and administrative expenses, those would be the selling and administrative expenses that vary with the number of units sold, things like commissions, for example, expense. So my total variable cost would be the $1.50 plus the 50 cents, or $2 per unit. That would be also be assuming that I'm operating within the capacity that I have available with my fixed cost. There would be $2 per unit for marginal cost as well. My marginal revenue would be $5 per unit. Now notice that if I was selling as many widgets as I possibly could at $5 per unit, then in order to pick up another customer, I'd have to sell to that additional customer for $4.80 per widget. Then my marginal revenue would then turn out to be $4.80, even though my revenue so far had been $5. So keep that in mind when we're talking about things like marginal revenue. I've made a simple assumption everybody pays the same price, basically. All right. In terms of my fixed manufacturing costs, those would be the ones, my fixed factory overhead, the ones that don't vary per unit. Those would be $3,000 per month. My fixed selling and administrative expenses, those would be $2,000 per month. So my total fixed costs would be the $3,000 plus the $2,000, and I set up a formula here for $5,000. All right. My total sales, I set up as a formula that's going to equal to the selling price per unit, which is right now $5 per unit, times the number of units sold per month, which is, I haven't actually filled in a number yet because that's what I'm going to calculate for in terms of calculating the break even. Right. So right now my total sales are at $0. My total costs are going to be a function of my total fixed costs, which are $5,000, and my total variable costs. My total variable costs are going to be the $2 per unit times the number of units sold per month. Again, I haven't calculated that out. So assuming that I'm selling right now 0 units, then my total costs are going to be $5,000. Now, my profit's going to be the difference between my total sales, which right now are $0, and my total costs, which are $5,000. Right? Now, I have a formula in the textbook to calculate what the break-even point is going to be. That break-even point is the fixed cost divided by the contribution margin. Contribution margin basically is the difference between the selling price minus the variable cost per unit. So my contribution margin is going to be the $5,000 worth of fixed costs divided by $5 per unit of selling price minus the $2 per unit of variable cost per unit. Or if I do the math out on there, it's going to come out to 1,667 units per month. If I want to use something known as Goal Seeker, I can use that as well. Goal Seeker is a tool that's built into Excel, and it requires that I have a formula here again in this profit, and I go into my data ribbon. So make sure you click on the data ribbon. You go to the What If Analysis and click on Goal Seeker. And Goal Seeker says, and I can move this little box for me, what is a cell that I'm looking to get a value for? So the cell that I'm looking to get a value for, in my case here, is going to be the profit. So I clicked on the profit, and that must have a formula in it. If it doesn't have a formula, if you actually typed in a number, it's not going to work. It must have a formula. All right, it's going to give you an error if you don't. To a value, now if I want to have a break-even is basically defined as being the point at which my total revenue equal my total cost. So that's going to be $0, right? By changing the cell, and what I'm looking for is I'm looking to figure out how many units I need to sell in order to break even. So that's going to be the cell for the number of units per month, and I'm going to go ahead and hit OK. And it tells me that I need to sell 1,666.67 units, or 1,667 units, in order to break even. So I'm going to hit OK. Now, if I wanted to calculate what my average costs are going to be per unit, my average cost per unit are going to be equal to my total cost of the $8,333 divided by 1,666.67 units, and that's going to be an average cost of $5 per unit. Right? So that's a function that's different between my contribution margin, because it basically, what it's done is it allocated my fixed costs. My fixed costs were $5,000. It allocated those over my 1,667 units. All right. Now I also want to do a short example about net present value. Now that short example comes from the Chapter 5 notes, and that was problem 5-2. It says, suppose an initial investment of $100 will return $50 per year for 3 years. Assume $50 is received at the end of each year. Is this a profitable investment, assuming that the discount rate is 20%? So what does discount rate mean? Discount rate basically means is what does it actually cost you for capital? So that's not going to really be interest rate. If you're a for-profit company, it's going to be a function of both what your stockholders expect to get for a return on their monies that they actually invest into the company, as well as a function of what the debt actually costs you. So if your company is financed 50% by stock and 50% by debt, it's going to be half of the cost of what stockholders expect to return in the long term, plus half of the cost of what the debt actually costs you after tax in the long term, right? So that's basically a concept for the finance class. And net present value is also a concept you're going to cover in the finance class, so don't worry too much about it over here. But let's go back. I set up I set this up as a short tab over here. So assume again my cost is $100. My savings or my revenues here are going to be equal to $50. So actually, I make this at $50. If my and depending upon how I'm doing this, I can set this up as positive or negative. You'll see how it's a little bit different depending on which formula I choose to use. My discount rate was given as being 20%. The life of the project was given to be 3 years. So I can use a couple of different formulas that are built into Excel. One of the formulas to figure out the present value of the project is what we call the present value formula. So present value formula, I type in equals PV, and it asks me for the rate. So I click on the cell that has the rate in it. Then it asks me for the number of periods. So I click on the cell that has the number of periods in it. And I'm sorry, I didn't hit my comma afterwards. I have to hit my comma after that to tell me that there's more arguments here for my function, and then a function for my revenues. My revenues are $50 per unit. Now, net present value basically assumes that we're talking about present value of the money. The PV formula assumes that we're looking for monies going out. So generally, we leave the money in terms of a positive number for money going out. So I'm talking about money coming in. So just kind of be careful here. Since I'm talking about money coming in, the PV formula assumes the money's going out. So I have to put it in a negative because it's telling me that this is money coming in instead. All right. Now, I could add in a future value if I'm going to be getting a specific amount of money in the future when this at the end of the 3 years as well, and I'm not going to be getting anything there. So if I want, I can leave that blank. Now, it asks me if I'm assuming, do I want to have assume that the money is being received at the beginning of the period or at the end of the period. If you don't put anything here, Excel assumes that the money is going to be received at the end of the period, or you can type in a 0 if you want to, and close my argument out, and it tells me $105.32 is my present value because I haven't taken into consideration my cost. So if I then subtract out the cost of the investment of the $100, I get that the present value of the project is $5.32. Right. One thing I have to assume here, kind of bring up to your attention here, is the present value formula assumes that your money is coming in the form of an annuity, or going out in terms of an annuity. So again, it was equal PV, and put in the number of periods, the rate rather first, And the rate you can actually type into a cell, or you can type into the formula. If you type in 20 in the formula, you want to type in either 0.2 for 20% or the 20% sign, either one of those, comma for the next argument, the number of periods. Again, you could type in 3 or reference a cell. I like to use a specific spreadsheet because I can change some of the values to do like what if analysis over here. My payment here. Now, this using the PV formula assumes that the money again is going out, and it assumes that the money is going out at an even rate per year. And so this case here, my money is actually coming in, so I again made it a negative number to assume the money was coming in. And I did the 50. I closed the parenthesis, and this gave me only the present value of the money coming in. So I have to subtract out the present value of the money going out, the $100, and again I got the $5.32. So again, that use of the PV formula assumed that the money that was coming in or going out is in the form of an annuity, basically equal amounts at equal intervals. If my monies are at a different amount per period, then I would have to use the Npv formula, which is a little bit different instead. Now, in order to use the Npv formula, I have to set up a little bit of an array, a spreadsheet here, a little bit of a spreadsheet, a section of the spreadsheet if you want to, that indicates what the cash flow is per period, right? So again, I did the equals Npv formula, so now the formula is a little bit different. Equals Npv for net present value, and it asked me to put in the rate. The rate was the 20%, and now it doesn't ask me for the number of periods because I'm giving it what the value is of the cash that's coming in or going out every single period. So in this case here, it's assuming that the money is actually coming in the net PV formula because it's net of the money coming out. All right, so the money coming in every year, that would be the difference between the additional revenue and the additional cost every single year, which would not take into consideration the actual cost of the investment. I can close out my argument, and then I have to subtract out the cost of my investment of the $100, and again I get the same $5.32. So the big difference between the PV formula and the Npv formula is the PV formula assumes that we have money's going out only. So if we have money's coming in, we have to make them negative, and it also assumes that we have an equal amount of money coming in at an equal interval. That would be what we call an annuity, where the Npv formula, we could have different amounts of money coming in every year. So one year we might have $50 coming in, one year we might have $0, another year we might have a negative $50 coming in. All right, and that one there assumes that the money is coming in, so if we want to make it going out, we have to put in a negative on that. All right, hopefully that was helpful to everybody, and we'll wait. That will be the end of the video for today. So let me close out.